Chapter 9. 5 more don'ts for investors. 1. Don't overstress diversification. No investment principle is more widely acclaimed than diversification. Some cynics have hinted that this is because the concept is so simple that even stockbrokers can understand it. Be that as it may, there is very little chance of the average investor being influenced to practice insufficient diversification. The horrors of what can happen to those who put all their eggs in one basket are too constantly being expounded. Too few people, however, give sufficient thought to the evils of the other extreme. This is the disadvantage of having eggs in so many baskets that a lot of the eggs do not end up in really attractive baskets, and it is impossible to keep watching all the baskets after the eggs get put into them. For example, among investors with common stock holdings having a market value of $250,000 to $500,000, the percentage who own 25 or more different stocks is appalling. It is not this number of 25 or more which itself is appalling. Rather, it is that in the great majority of instances only a small percentage of such holdings is in attractive stocks about which the investor or his advisor has a high degree of knowledge. Investors have been so oversold on diversification that fear of having too many eggs in one basket has caused them to put far too little into companies they thoroughly know and far too much in others about which they know nothing at all. It never seems to occur to them, much less to their advisors, that buying a company without having sufficient knowledge of it may be even more dangerous than having inadequate diversification. How much diversification is really necessary and how much is dangerous? It is somewhat like infantrymen stacking rifles. A rifleman cannot get as firm a stack by balancing 2 rifles as he can by using 5 or 6 properly placed. However, he can get just as secure a stack with 5 as he could with 50. In this matter of diversification, however, there is one big difference between stacking rifles and common stocks. With rifles, the number needed for a firm stack does not usually depend on the kind of rifle used. With stocks, the nature of the stock itself has a tremendous amount to do with the amount of diversification actually needed. Some companies, such as most of the major chemical manufacturers, have a considerable degree of diversification within the company itself. While all of their products may be classified as chemicals, many of these chemicals may have most of the attributes found in products from completely different industries. Some may have completely different manufacturing problems. They may be sold against different competition to different types of customers. Furthermore, at times when only one type of chemical is involved, the customer group may be such a broad section of industry that a considerable element of internal diversification may still be present. The breadth and depth of a company's management personnel, that is, how far a company has progressed away from one-man management, are also important factors in deciding how much diversification protection is intrinsically needed. Finally, holdings in highly cyclical industries, that is, those that fluctuate sharply with changes in the state of the business cycle, also inherently require being balanced by somewhat greater diversification than do shares in lines less subject to this type of intermittent fluctuation. This difference between the amount of internal diversification found in stocks makes it impossible to set down hard and fast rules as to the minimum amount of diversification the average investor requires for optimum results. The relationship between the industries involved will also be a factor. For example, an investor with 10 stocks in equal amounts, but 8 of them bank stocks, may have completely inadequate diversification. In contrast, the same investor with each of his 10 stocks in a completely different industry may have far more diversification than he really needs. Recognizing, therefore, that each case is different and that no precise rules can be laid down, the following is suggested as a rough guide to what might be considered as minimum diversification needs for all but the very smallest type of investor. A. All investments might be confined solely to the large entrenched type of properly selected growth stock, of which Dow, DuPont, and IBM have already been mentioned as typical examples. In this event, the investor might have a minimum goal of 5 such stocks in all. This means that he would not invest over 20% of his total original commitment in any one of these stocks. It does not mean that should one grow more rapidly than the rest, so that 10 years later he found 40% of his total market value in one stock, he should in any sense disturb such a holding. This assumes, of course, that he has gotten to know his holding and the future continues to look at least as bright for these stocks as has the recent past. An investor using this guide of 20% of his original investment for each company should see that there is no more than a moderate amount of overlapping, if any, between the product lines of his 5 companies. Thus, for example, if Dow were one of his 5 companies, there would seem to me to be no reason why DuPont might not be another. There are relatively few places where the product lines of these two companies overlap or compete. If he were to have Dow and some other company closer to Dow in its fields of activity, his purchase might still be a wise one provided he had sufficient reason for making it. Having these two stocks in similar lines of activity might prove very profitable over the years. However, in such an instance the investor should keep in mind that his diversification is essentially inadequate and therefore he should be alert for troubles which might affect the industry involved. B. Some or all of his investments might fall into the category of stocks about midway between the young growth companies with their high degree of risk and the institutional type of investment described above. These would be companies with a good management team rather than one-man management. They would be companies doing a volume of business somewhere between $15 and $100 million a year and rather well entrenched in their industries. At least two of such companies should be considered as necessary to balance each single company of the A type. In other words, if only companies in this B group were involved, an investor might start out with 10% of his available funds in each. This would make a total of 10 stocks in all. However, companies in this general classification can vary considerably among themselves as to their degree of risk. It might be prudent to consider those with the greater inherent risk as candidates for 8% of original investment rather than 10%. In any event, looking to each stock of this class as a candidate for 8 to 10% of total original investment, in contrast to 20% for the A group, should again provide the framework for adequate minimum diversification. Companies of this B group are usually somewhat harder for the investor to recognize than those of the A or institutional type. Therefore, it might be worthwhile to furnish a brief description of one or two such companies which I have had the opportunity to observe rather closely and which could be considered typical examples. Let us see what I said about such companies in the original edition and how they appear today. The first B company to which I referred was Mallory. I said, Mallory and Company, Inc. enjoys a surprising degree of internal diversification. Its principal products are components for the electronic and electrical industries, special metals, and batteries. For its more important product lines, it is a major factor in the respective industries, and in a few of them it is the largest producer. Many of its product lines, such as electronic components and special metals, serve some of the most rapidly growing segments of American industry, giving indications that Mallory's growth should continue. In 10 years, sales have increased almost fourfold to a volume of about $80 million in 1957, with about one-third of this increase resulting from carefully planned outside acquisitions and about two-thirds from internal growth. Profit margins over this period have been a bit lower than would normally be considered satisfactory for a company of this B group, but part of this is attributable to above-average expenditures on research. More significantly, steps have been taken which are beginning to show indications of important improvement in this factor. Management has demonstrated considerable ingenuity under a dynamic president and in recent years has been increasing importantly in depth. Mallory shares enjoyed about a five-fold increase in value during the 10-year period of 1946 to 1956, frequently selling around 15 times current earnings. Perhaps investment-wise, one of the most important factors about Mallory lies not within the company itself but in its anticipated one-third interest in the Mallory Sharon Metals Corporation. This company is being planned as a combination of the Mallory Sharon Titanium Corporation, half of which is owned by Mallory and Company and which has already proved to be an interesting venture for Mallory, and National Distillers operations in the raw material stages of the same industry. This new company gives indication of being one of the lowest-cost integrated titanium producers and as such should play a major role in the probable growth of this young industry. Meanwhile, the corporation in 1958 is expected to start its first commercially significant zirconium product and has within its organization considerable know-how in other commercially new wonder metals such as tantalum and columbium. This partially owned company gives indications of becoming a world leader in not one but a series of metals that promise to play a growing part in the atomic, chemical, and guided missile age of tomorrow. As such, it could be an asset of tremendous dollar significance to increase the growth that appears inherent in Mallory itself. If I were writing these words today, slightly over 2 years later, I would write them somewhat differently. I would tone down moderately my enthusiasm for the possible contributions of the one-third owned Mallory Sharon Metals Corporation. I think everything I said 2 years ago could still occur. However, particularly so far as titanium is concerned, I believe it may take longer to find and develop sizable markets for this metal than had seemed to be the case 2 years ago. On the other hand, I would be inclined to strengthen my words for the Mallory company itself by about the degree I would weaken them for its affiliate. The trend I mentioned of increasing management in depth has progressed importantly during this period. While Mallory, as a component supplier to the durable goods industry, is in a line of business that is bound to feel the ravages of any major general slide, the management showed unusual adroitness in adjusting to 1958 conditions and held earnings to $1.89 per share against the all-time peak of $2.06 the year before. Earnings came back fast in 1959 and promised to make new records for the full year somewhere around $2.75 per share. Furthermore, these earnings are being established in the face of decreasing but still heavy costs for certain of the newer divisions. This showing gives promise that if general economic conditions remain reasonably prosperous, significant further growth in profits will be seen in 1960. Mallory stock is one of the few examples cited in this book that to date has done worse rather than better than the market as a whole. Although I suspect this company has been more successful than some of its competitors in meeting Japanese competition in the electronic components phases of its business, this threat may be a reason for the relatively poor market action. Another reason may be lack of interest by much of the financial community in a business that is not easily classified in one industry or another but cuts across several. This may change in time, particularly as awareness grows that its miniature battery lines are not so far removed from some glamorous growth fields, for they should grow with the steady trend toward miniaturization in electronics. At any rate, this stock, which was at 35 when the first edition was written after allowing for 2% stock dividends since, is now selling at 37.25. Now let us see what I said about the other B Group example I discussed in the original edition. The Beryllium Corporation is another good example of a Group B investment. The corporate title of this company has a young company implication that causes uninformed people to assume that the stock carries with it a greater degree of risk than may actually exist. A low-cost producer, it is the only integrated company making master alloys of beryllium copper and beryllium aluminum and also operating a fabricating plant in which the master alloy is turned into rod, bar, strip, extrusions, etc. And, in the case of tools, into finished products. Sales have increased about 6 times during the 10-year period ending in 1957 to a total of approximately $16 million. A growing percentage of these sales is to electronic, computing machine, and other industries promising rapid growth in the years ahead. With important new uses such as beryllium copper dyes just beginning to be of sales importance, it would seem that the good growth rate of the past 10 years may be just an indication of what is to come. This would tend to justify the price-earnings ratio of around 20 at which this stock has frequently sold in the past 5 years. Indicating that this growth may continue for many years to come, the RAND Corporation, brilliant research arm of the Air Force owned by the government, has been quoted in the press as predicting an important future in the 1960s for the as yet almost non-existent field of beryllium metal as a structural material. The RAND Corporation, among other things, correctly foretold, shortly after the war, the development in titanium. More immediate than any eventual market that may develop for beryllium as a structural material, 1958 should see this company bring into volume production another brand new product. This is beryllium metal for atomic purposes. This product, being made in a completely separate plant from the older master alloy lines, is under long-term contract to the Atomic Energy Commission. It gives indications of having a big future in the nuclear industry where demand will probably occur from both government and private industry sources. Management is alert. In fact, this company qualifies rather favorably under our 15 points in regard to all aspects but one, where the deficiency is realized and steps have already been started to correct it. As in the case of Mallory, the past 2 years have brought both pluses and minuses to the picture I portrayed at that time. However, the favorable developments seem to have by far outweighed the unfavorable, as should be the case if a company is to prove the right sort of investment. On the unfavorable side, the prospects for beryllium copper dyes, mentioned 2 years before, appear to have lost much of their luster, and the long-term growth curve of the entire alloy end of the business may be somewhat less brisk than indicated in that description. Meanwhile, nuclear demand for beryllium metal over the next few years appears to be somewhat less now than it was then. However, possibly far outbalancing this, there are steadily increasing signs that there may be a most dramatic growth in the demand for beryllium metal for many types of airborne purposes. The start of this demand is already here. It is appearing in so many places and for so many different kinds of products that no one is safe in predicting what its limitations may be. This may not prove quite as favorable as might otherwise be judged, for it may make the field so attractive as to bring threats of a major competitive technological breakthrough from some company not now in the field. However, fortunately, the company may have made major strides in strengthening itself in the only one of our 15 points where it had been weak. This was in its research activities. How has the stock responded to all this? When the first edition was written, it was at 16.16 after allowing for the various stock dividends that have been paid since. Today it is at 26.5, a gain of 64%. A few other companies with which I am somewhat less familiar but which I believe have management, trade position, growth prospects, and other characteristics which easily qualify them as good examples of this B group are Foot Minerals Company, Frieden Calculating Machine Company, Inc., and Sprague Electric Company. Each of these companies has proven a highly desirable investment for those who have held the shares for a period of years. Sprague Electric roughly quadrupled in value during the 1947 to 1957 period. Frieden stock was first offered to the public in 1954, but in less than 3 years it had increased about 2.5 times in market value. By 1957 it was selling at better than 4 times the price at which blocks of stock are believed to have changed hands privately about a year prior to this public offering. These price increases, satisfactory as they might appear to most investors, were relatively minor compared to what has happened to the shares of the Foot Minerals Company. This stock was listed on the New York Stock Exchange early in 1957. Prior to that time, the stock was traded over the counter and was first available to the public in 1947. At that time, the stock was selling at about $40 per share. Due to stock dividends and split-ups, the investor who purchased 100 shares at the time of the original financing in 1947 and held on now has over 2,400 shares. The stock recently sold at approximately $50. Finally, there are the small companies with staggering possibilities of gain for the successful but complete or almost complete loss of investment for the unsuccessful. I have already pointed out elsewhere why I believe the amount, if any, of such securities in an investment list should vary according to the circumstances and goals of the particular investor. However, there are 2 good rules to follow in regard to investments of this type. One has already been mentioned. Never put any funds into them that you cannot afford to lose. The other is that larger investors should never at the time of the original investment put over 5% of available funds into any one such company. As pointed out elsewhere, one of the risks of the small investor is that he may be too small to obtain the spectacular prospects of this type of investment and still get the benefits of proper diversification. In the original edition, I referred to Ampex as it was in 1953 and Alox in 1956 as examples of the huge potential but high-risk companies that fall into the C classification. How have these companies done since? Alox, which was at 10 when the first edition was completed, is at 7 5/8 today. In contrast, Ampex's market performance continues brilliant and demonstrates why once an outstanding management has proven itself and fundamental conditions have not changed. Shares should never be sold just because the stock has had a huge rise and may seem temporarily high-priced. In the discussion on research in Chapter 3, I mentioned that in the first 4 years following the offering of the stock to the public in 1953, it had risen 700%. When I finished the original edition, it was at 20. Today, with sales and earnings up dramatically year after year and with 80% of today's sales in products that were not in existence only 4 years ago, it is at 107.5. This is a gain of 437% in just over 2 years. It is a gain of over 3,500% in 6 years. In other words, $10,000 placed in Ampex in 1953 would have a market value of over $350,000 today in a company with a proven ability to score one technical and business triumph after another. Other situations with which I am less familiar but which might well fall in this category were Litton Industries Incorporated, when its shares were first offered to the public, and metal hydrides. However, one characteristic of this type of company should be kept in mind from the standpoint of diversification. They entail so much risk and offer such promising prospects that, in time, one of 2 things usually happens. Either they fail, or else they grow in trade position, management depth, and competitive strength to a point where they can be classified in the B rather than the C group. When this has happened, the shares held in them usually have advanced so spectacularly in market price that, depending on what has happened to the value of an investor's other holdings during the period, they may then represent a considerably greater percent of the total portfolio than they formerly did. However, B stocks are so much safer than C stocks that they may be retained in greater volume without sacrificing proper diversification. Therefore, if the company has changed in this way, there is seldom reason to sell stock, at least not on the ground that the market rise has resulted in this company representing too great a percentage of total holdings. This change from a C to a B company is, for example, exactly what happened during the 1956 to 1957 period in the case of Ampex. As the company tripled in size and profits rose even faster, and as the market for its magnetic recorders and the components thereof broadened into more and more growth industries, this company grew in intrinsic strength to a point where it could be classified in the B group. It no longer carried with it the element of extreme investment risk. When this point had been reached, a considerably larger percentage of total investment might be held in Ampex without violating principles of prudent diversification. All the above percentages represent merely a minimum or prudent standard of diversification. Going below this limit is a bit like driving an automobile above normal speeds. A driver doing this may get where he wants to go sooner than he otherwise would. However, he should keep in mind that he is driving at a rate requiring extra alertness and vigilance. Forgetting this, he may not only fail to arrive at his destination more quickly, he may never get there at all. How about the other side of the coin? Is there any reason an investor should not have more diversification than something resembling the minimum amounts mentioned? There is no reason whatsoever, as long as the additional holdings are ones which appear equivalent in attractiveness to this minimum number of holdings in regard to two matters. These additional securities should be equivalent to the other holdings in regard to the degree of growth which appears attainable in relation to the risks involved. They should also be equivalent in regard to the investor's ability to keep in touch with and follow his investment once he has made it. However, practical investors usually learn their problem is finding enough outstanding investments rather than choosing among too many. The occasional investor who does find more such unusual companies than he really needs seldom has the time to keep in close enough touch with all additional corporations. Usually, a very long list of securities is not a sign of the brilliant investor, but of one who is unsure of himself. If the investor owns stock in so many companies that he cannot keep in touch with their managements directly or indirectly, he is rather sure to end up in worse shape than if he had owned stock in too few companies. An investor should always realize that some mistakes are going to be made and that he should have sufficient diversification so that an occasional mistake will not prove crippling. However, beyond this point, he should take extreme care to own not the most, but the best. In the field of common stocks, a little bit of a great many can never be more than a poor substitute for a few of the outstanding. 2. Don't be afraid of buying on a war scare. Common stocks are usually of greatest interest to people with imagination. Our imagination is staggered by the utter horror of modern war. The result is that every time the international stresses of our world produce either a war scare or an actual war, common stocks reflect it. This is a psychological phenomenon which makes little sense financially. Any decent human being becomes appalled at the slaughter and suffering caused by the mass killings of war. In today's atomic age, there is added a deep personal fear for the safety of those closest to us and for ourselves. This worry, fear, and distaste for what lies ahead can often distort any appraisal of purely economic factors. The fears of mass destruction of property, almost confiscatory higher taxes, and government interference with business dominate what thinking we try to do on financial matters. People operating in such a mental climate are inclined to overlook some even more fundamental economic influences. The results are always the same. Through the entire 20th century, with a single exception, every time major war has broken out anywhere in the world or whenever American forces have become involved in any fighting whatever, the American stock market has always plunged sharply downward. This one exception was the outbreak of World War II in September 1939. At that time, after an abortive rally on thoughts of fat war contracts to a neutral nation, the market soon was following the typical downward course, a course which some months later resembled panic as news of German victories began piling up. Nevertheless, at the conclusion of all actual fighting, regardless of whether it was World War I, World War II, or Korea, most stocks were selling at levels vastly higher than prevailed before there was any thought of war at all. Furthermore, at least 10 times in the last 22 years, news has come of other international crises which gave threat of major war. In every instance, stocks dipped sharply on the fear of war and rebounded sharply as the war scare subsided. What do investors overlook that causes them to dump stocks both on the fear of war and on the arrival of war itself, even though by the end of the war stocks have always gone much higher than lower? They forget that stock prices are quotations expressed in money. Modern war always causes governments to spend far more than they can possibly collect from their taxpayers while the war is being waged. This causes a vast increase in the amount of money so that each individual unit of money, such as a dollar, becomes worth less than it was before. It takes lots more dollars to buy the same number of shares of stock. This, of course, is the classic form of inflation. In other words, war is always bearish on money. To sell stock at the threatened or actual outbreak of hostilities so as to get into cash is extreme financial lunacy. Actually, just the opposite should be done. If an investor has about decided to buy a particular common stock and the arrival of a full-blown war scare starts knocking down the price, he should ignore the scare psychology of the moment and definitely begin buying. This is the time when having surplus cash for investment becomes least, not most, desirable. However, here a problem presents itself. How fast should he buy? How far down will the stock go? As long as the downward influence is a war scare and not war, there's no way of knowing. If actual hostilities break out, the price would undoubtedly go still lower, perhaps a lot lower. Therefore, the thing to do is to buy, but buy slowly and at a scale down on just a threat of war. If war occurs, then increase the tempo of buying significantly. Just be sure to buy into companies either with products or services the demand for which will continue in wartime or which can convert their facilities to wartime operations. The great majority of companies can so qualify under today's conditions of total war and manufacturing flexibility. Do stocks actually become more valuable in wartime, or is it just money which declines in value? That depends on circumstances. By the grace of God, our country has never been defeated in any war in which it has engaged. In war, particularly modern war, the money of the defeated side is likely to become completely or almost worthless, and common stocks would lose most of their value. Certainly, if the United States were to be defeated by communist Russia, both our money and our stocks would become valueless. It would then make little difference what investors might have done. On the other hand, if a war is won or stalemated, what happens to the real value of stocks will vary with the individual war and the individual stock. In World War I, when the enormous pre-war savings of England and France were pouring into this country, most stocks probably increased their real worth even more than might have been the case if the same years had been a period of peace. This, however, was a one-time condition that will not be repeated. Expressed in constant dollars, that is, in real value, American stocks in both World War II and the Korean period undoubtedly did fare less well than if the same period had been one of peace. Aside from the crushing taxes, there was too great a diversion of effort from the more profitable peacetime lines to abnormally narrow-margin defense work. If the magnificent research effort spent on these narrow-margin defense projects could have been channeled to normal peacetime lines, stockholders' profits would have been far greater, assuming, of course, that there would still have been a free America in which any profits could have been enjoyed at all. The reason for buying stocks on war or fear of war is not that war in itself is ever again likely to be profitable to American stockholders. It is just that money becomes even less desirable so that stock prices, which are expressed in units of money, always go up. 3. Don't forget your Gilbert and Sullivan. Gilbert and Sullivan are hardly considered authorities on the stock market. Nevertheless, we might keep in mind their flowers that bloom in the spring, trala, which, they tell us, have nothing to do with the case. There are certain superficial financial statistics which are frequently given an undeserved degree of attention by many investors. Possibly it is an exaggeration to say that they completely parallel Gilbert and Sullivan's flowers that bloom in the spring. Instead of saying they have nothing to do with the case, we might say they have very little to do with it. Foremost among such statistics are the price ranges at which a stock has sold in former years. For some reason, the first thing many investors want to see when they are considering buying a particular stock is a table giving the highest and lowest price at which that stock has sold in each of the past 5 or 10 years. They go through a sort of mental mumbo-jumbo and come up with a nice round figure which is the price they are willing to pay for the particular stock. Is this illogical? Is it financially dangerous? The answer to both questions is emphatically yes. It is dangerous because it puts the emphasis on what does not particularly matter and diverts attention from what does matter. This frequently causes investors to pass up a situation in which they would make big profits in order to go into one where the profits will be much smaller. To understand this, we must see why the mental process is so illogical. What makes the price at which a stock sells? It is the composite estimate at that moment of what all those interested think the corrective value of such shares may be. It is the composite appraisal of the outlook for this company by all potential buyers and sellers weighted by the number of shares each buyer or seller is disposed to bid for or offer in relation to a similar appraisal at the same moment of the outlook for other companies with their individual prospects. Occasionally, something like forced liquidation will produce a moderate deviation from this figure. This happens when a large holder presses stock on the market for reasons such as liquidating an estate or paying off a loan, which may not be directly related to the seller's view of the real value of the shares. However, such pressures usually cause only moderate variation from the composite appraisal of the prevailing price of the shares, since bargain hunters normally step in to take advantage of the situation, which thereby adjusts itself. The point which is of real significance is that the price is based on the current appraisal of the situation. As changes in the affairs of the company become known, these appraisals become correspondingly more or less favorable. In relation to other stocks, these particular shares then move up or down. If the factors appraised were judged correctly, the stock becomes permanently more or less valuable in relation to other stocks. The shares then stay up or down. If more of these same factors continue to develop, they in turn are recognized by the financial community. The stock then goes and stays either further up or down as the case may be. Therefore, the price at which the stock sold 4 years ago may have little or no real relationship to the price at which it sells today. The company may have developed a host of able new executives, a series of new and highly profitable products, or any number of similar desirable attributes that make the stock intrinsically worth 4 times as much in relation to the price of other stocks as it was worth 4 years ago. The company might have fallen into the hands of an inefficient management and slipped so badly in relation to competition that the only way recovery could occur would be through the raising of much new capital. This might force such a dilution of the shares that the stock today could not possibly be worth more than a quarter of the price of 4 years ago. Against this background, it can be seen why investors so frequently pass up stocks which would have brought them huge future gains for ones where the gain is very much smaller. By giving heavy emphasis to the stock that hasn't gone up yet, they are unconsciously subscribing to the delusion that all stocks go up about the same amount and that the one that has already risen a lot will not climb further, while the one that has not yet gone up has something to do with it. Nothing could be further from the truth. The fact that a stock has or has not risen in the last several years is of no significance whatsoever in determining whether it should be bought now. What does matter is whether enough improvement has taken place or is likely to take place in the future to justify importantly higher prices than those now prevailing. Similarly, many investors will give heavy weight to the per-share earnings of the past 5 years in trying to decide whether a stock should be bought. To look at the per-share earnings by themselves and give the earnings of 4 or 5 years ago any significance is like trying to get useful work from an engine which is unconnected to any device to which that engine's power is supposed to be applied. Just knowing by itself that 4 or 5 years ago a company's per-share earnings were either 4 times or a quarter of this year's earnings has almost no significance in indicating whether a particular stock should be bought or sold. Again, what counts is knowledge of background conditions. An understanding of what probably will happen over the next several years is of overriding importance. The investor is constantly being fed a diet of reports and so-called analyses largely centered around these price figures for the past 5 years. He should keep in mind that it is the next 5 years' earnings, not those of the past 5 years, that now matter to him. One reason he is fed such a diet of back statistics is that if this type of material is put in a report, it is not hard to be sure it is correct. If more important matters are gone into, subsequent events may make the report look quite silly. Therefore, there is a strong temptation to fill up as much space as possible with indisputable facts, whether or not the facts are significant. However, many people in the financial community place emphasis on this type of prior year statistics for a different set of reasons. They seem to be unable to grasp how great can be the change in just a few years' time in the real value of certain types of modern corporations. Therefore, they emphasize these past earnings records in a sincere belief that detailed accounting descriptions of what happened last year will give a true picture of what will happen next year. This may be true for certain classes of regulated companies such as public utilities. For the type of enterprise which I believe should interest an investor desiring the best results for his money, it can be completely false. A striking example of this centers around events with which I had the good fortune to be quite familiar. In the summer of 1956, an opportunity arose to buy a fair-sized block of shares in Texas Instruments Incorporated from its principal officers who were also its largest stockholders. Careful study of this company revealed that it rated not just well but magnificently in regard to our 15-point test. Reason for the officers to sell appeared entirely legitimate. This occurs frequently in true growth companies. Their holdings had already advanced so much that several of them had become millionaires so far as their holdings in their own company were concerned. In contrast, their other assets were relatively negligible. Therefore, particularly since they were selling but a tiny part of the shares they owned, some diversification seemed entirely in order. The ever-present possibility of a state tax liability alone would be sufficient to make such a course prudent from the standpoint of these key executives regardless of the future of their company. At any rate, negotiations were completed to acquire these shares at a price of 14. This represented 20 times the anticipated 1956 per share earnings of about 70 cents. To anyone who gave particular weight to past statistics, this seemed well beyond the bounds of prudence. Per share earnings had been reported at 39 cents, 40 cents, 48 cents, and 50 cents for the prior 4 years of 1952 to 1955 respectively, hardly an exciting growth record. Even more depressing to those who subordinate the more important factors of management and current business trends to superficial statistical comparisons, the company, through a corporate acquisition, had obtained the benefits of some loss carryforward, which had made possible subnormal income tax charges during much of this period. This made any price calculated on the basis of past statistics seem even higher. Finally, even if 1956 earnings were included in an evaluation, a superficial study of this situation might still have produced grave forebodings. True, the company was currently doing remarkably well in the promising field of transistors. But regardless of the obviously glowing future for the semiconductor industry as a whole, how long could a company of this size be expected to maintain its strong trade position against the larger and older companies with much stronger balance sheets, which were sure to make a major competitive effort to participate in the great growth that lay ahead for transistors? When the usual SEC channels reported this officers selling, a rash of heavy trading broke out in Texas Instruments shares with relatively little change in price. Much of the selling, I suspect, was induced by various brokerage comments that appeared. Most of these furnished the past statistical record and commented on the historically high price, the competition that lay ahead, and the inside selling. One such bulletin went so far as to express complete agreement with the management of Texas Instruments. It reported the officers were selling and stated, "We agree with them and recommend the same course." The major buyer during this period, I have been told, was a large and well-informed institution. What happened in the next 12 months? Texas Instruments' geophysical and military electronic business, overlooked in the flurry of controversy, continued to grow. The semiconductor, transistor division grew even more rapidly. More important than the growth in transistor volume were the great strides taken by this able management in research, in plans for mechanization, and in building up the distribution organization in this key semiconductor field. As evidence piled up that 1956 results were not a flash in the pan, but that this relatively small company would continue as one of the largest and lowest-cost producers in what promises to be one of the fastest-growing segments of American industry, the financial community began revising upward the price-earnings ratio it would pay for a chance to participate in this well-run enterprise. As the summer of 1957 came around and the management publicly estimated that year's per-share earnings at around $1.10, the 54% growth in earnings had produced in just 12 months an approximate 100% increase in market value. In the original edition, I went on to say, I suspect that if the headquarters of the principal divisions of this company were not located in Dallas and Houston, but were situated along the northern half of the Atlantic seaboard or in the Los Angeles metropolitan area, where more financial analysts and other managers of important funds could more easily learn about the company, this price-earnings ratio might have gone even higher during this period. If, as appears probable, Texas Instruments sales and earnings continue their sharp upward trend for some years to come, it will be interesting to see whether this continued growth of itself does not in time provide some further upward change in the price-earnings ratio. If this happens, the stock would again go up at an even faster rate than the earnings are advancing, the combination which always produces the sharpest increases in share prices. Has this optimistic forecast been confirmed? A look at the record may jolt those who still insist that it is possible to appraise an investment by a superficial analysis of past earnings and little more. Profits rose from $1.11 per share in 1957 to $1.84 in 1958 and give promise of topping $3.50 in 1959. Since the first edition of this book was completed, the company attained honors that were bound to rivet the attention of the financial community upon it. In 1958, in the face of competition from some of the generally acclaimed giants of the electronics and electrical equipment industry, International Business Machines Corporation, overwhelmingly the largest electronic calculating machine manufacturer in the world, selected Texas Instruments to be its associate for joint research effort in the application of semiconductors to this type of equipment. Again, in 1959, Texas Instruments announced a technological breakthrough whereby it was possible to use semiconductor material of approximately the same size as existing transistors, not alone for a transistor but for a complete electronic circuit. What this may bring about in the way of miniaturization almost staggers the imagination. As the company has grown, its unusually able product research and development groups have increased proportionately. Today, few informed people have much doubt that the company's long series of technical and business firsts will continue in the years ahead. How has the market price of these shares responded to all this? Has the price-earnings ratio continued to advance as 22 months ago I indicated appeared probable? The record would appear to be in the affirmative. Per share earnings have a little more than tripled since 1957. The stock is up over 5 times from the price of $26.50 at which it was selling when the first edition was completed. The current price, incidentally, represents a gain of better than 1,000% from the price of $14, which was mentioned in the original edition as the price at which a fair-sized block of the stock had been bought less than 3.5 years before. In spite of this steep rise, it will be interesting to see whether further gains in sales and earnings in the years ahead do not produce still more worthwhile appreciation. This brings up another line of reasoning which causes some investors to pay undue attention to these unrelated statistics on past price ranges and per share earnings. This is the belief that whatever has happened for a number of years is bound to continue indefinitely. In other words, some investors will find a stock the per share earnings and market price of which have risen in each of the past 5 or 10 years. They will conclude that this trend is almost certain to continue indefinitely. I will agree that this might happen. But in view of the uncertainty in timing the results of research and of the costliness of bringing out the new products that make this type of growth possible, it is quite common for even the most outstanding growth companies to have occasional 1 to 3 year dips in their rate of earnings. Such dips can produce sharp declines in their shares. Therefore, to give emphasis to this kind of past earning record rather than to the background conditions that can control the future earning curve may prove very costly. Does all this mean that past earnings and price ranges should be completely ignored in deciding whether to buy a stock? No. It is only when given an importance they do not deserve that they become dangerous. They are helpful as long as it is realized they are only auxiliary tools to be used for specialized purposes and not major factors in deciding the attractiveness of a common stock. Thus, for example, a study of per share earnings for various prior years will throw considerable light on how cyclical a stock may be, that is, on how much the company's profits will be affected by the varying stages of the business cycle. More important, comparing past per share earnings with price ranges will furnish the price-earnings ratio at which the stock sold in the past. This serves as a base from which to start measuring what the price-earnings ratio may be in the future. Here again, however, it must be kept in mind that it is the future and not the past which governs. Perhaps the shares for years have steadily sold at only 8 times earnings. Now, however, changes in management, establishment of an outstanding research department, etc. are putting the company into the class that is currently selling around 15 times earnings instead of 8. Then anyone estimating future earnings and figuring the anticipated value of the shares at only 8 instead of 15 times earnings might again be leaning too heavily on past statistics. I headed this subdivision of my comments. Don't forget your Gilbert and Sullivan. Perhaps I should have headed it, "Don't be influenced by what doesn't matter." Statistics of former years' earnings and particularly of per-share price ranges of these former years quite frequently have nothing to do with the case. 4. Don't fail to consider time as well as price in buying a true growth stock. Let us consider an investment situation that occurs frequently. A company qualifies magnificently as to the standards set up under our 15 points. Furthermore, very important gains in earning power are going to appear about a year from now due to factors about which the financial community is, as yet, completely unaware. Even more important, there are strong indications that these new sources of earnings are going to grow importantly for at least several years after that. Under normal circumstances, the stock would obviously be a buy. However, there is a factor that gives us pause. Success of other ventures in prior years has given the stock so much glamour in the financial world that if it were not for these new and generally unknown influences, the stock might be considered to be reasonably priced around 20 and out of all reason at its present price of 32. Assuming that 5 years from now these new influences could easily cause it to be fully worth 75, should we, right now, pay 32 or 60% more than we believe the stock is worth? There is always the chance that these new developments might not turn out to be as good as we think. There is also the possibility that the stock might sink back to what we consider its real value of 20. Confronted with this situation, many conservative investors would watch quotations closely. If the stock got near 20, they would buy it eagerly. Otherwise, they would leave the shares alone. This happens often enough to be worthy of somewhat closer analysis. Is there anything sacred about our figure of 20? No, because it admittedly does not take into consideration an important element of future value, the factors we know and most others don't know which we believe will in a few years justify a price of 75. What is really important here is to find a way that we can buy the stock at a price close to the low point at which it will sell from here on in. Our concern is that if we buy at 32, the stock may subsequently go somewhere around 20. This would not alone cause us a temporary loss. More significant, it would mean that if the stock subsequently went to 75, we would have for our money only about 60% of the shares that we could have gotten if we had waited and bought at 20. Assuming that in 20 years still other new ventures would have given these shares a value not of 75 but of 200, this factor of the total number of shares we could have obtained for our money would prove extremely important. Fortunately, in a situation of this sort, there is another guidepost which may be relied on, even if some of my friends in the insurance and banking worlds seem to regard it as about as safe as trying to walk over water. This is to buy the shares not at a certain price, but at a certain date. From a study of other successful ventures carried through in the past by this same company, we can learn that these ventures were reflected in the stock's price at a particular point in their development. Perhaps it averaged about 1 month before these ventures reached the pilot plant stage. Assuming that our company's shares are still selling around 32, why not plan to buy these shares 5 months from today, which will be just 1 month before the pilot plant goes on stream? Of course, the shares can still go down after that. However, even if we had bought these shares at 20, there would have been no positive guarantee against a further drop. If we have a fair chance of buying at about as low a price as possible, aren't we accomplishing our objective, even if we feel that on the basis of the publicly known factors the stock should be lower? Under these circumstances, isn't it safer to decide to buy at a certain date rather than a certain price? Fundamentally, this approach does not ignore the concept of value at all. It only appears to ignore it. Except for the probability that there would be a far greater increase in value coming in the future, it would be just as illogical as some of my financial friends claim it to be to decide to buy on a specific future date rather than at a specific price. However, when the indications are strong that such an increase is coming, deciding the time you will buy rather than the price at which you will buy may bring you a stock about to have extreme further growth at or near the lowest price at which that stock will sell from that time on. After all, this is exactly what you should be trying to do when you make any stock purchase. 5. Don't follow the crowd. There is an important investment concept which is frequently difficult to understand without considerable financial experience. This is because its explanation does not lend itself easily to precise wording. It does not lend itself at all to reduction to mathematical formulae. Time and again throughout this book I have touched upon different influences that have resulted in a common stock going up or down in price. A change in net income, a change in a company's management, appearance of a new invention or a new discovery, a change in interest rates or tax laws. These are but a few random examples of conditions that will bring about a rise or fall in the quotations for a particular common stock. All these influences have one thing in common. They are real occurrences in the world about us. They are actions which have happened or are about to happen. Now we come to a very different type of price influence. This is a change which is purely psychological. Nothing has changed in the outside or economic world at all. The great majority of the financial community merely look upon the same circumstances from a different viewpoint than before. As a result of this changed way of appraising the same set of basic facts, they make a changed appraisal of the price or the price-earnings ratio they will pay for the same shares. There are fads and styles in the stock market just as there are in women's clothes. These can, for as much as several years at a time, produce distortions in the relationship of existing prices to real values almost as great as those faced by the merchant who can hardly give away a rack full of the highest quality knee-length dresses in a year when fashion decrees that they be worn to the ankle. Let me give a specific example. In 1948, I was chatting with a gentleman whom I believe to be an able investment man. He has served as president of the New York Society of Security Analysts, a position which is usually awarded only to the more able in the financial community. At any rate, I had just arrived in New York from a visit to the headquarters of the Dow Chemical Company at Midland, Michigan. I mentioned that earnings for the fiscal year just closing would be at new high levels and that I thought the stock was a real buy. He replied that he felt it was of historic and perhaps statistical interest that a company such as Dow could ever earn this much per share. He felt, however, that these earnings did not make the stock attractive since it was obvious that the company was enjoying a temporary post-war boom that could not last. He further explained that he felt it was impossible to judge the real value of stocks of this sort until there had occurred the same type of post-war depression that within a few years followed the Civil War and World War I. His reasoning, unfortunately, completely ignored all the potential further increase in value to this stock promised by the many new and interesting products the company was then developing. That in no future year did Dow's earnings fall anywhere near as low as this supposedly abnormal peak is not what should concern us here. Neither is the fact that from this supposedly high plateau at which it was then selling, the stock has since climbed many hundreds %. Our interest should be in why this normally able investment man would take the set of facts and derive from it a quite different conclusion as to the intrinsic value of the stock than he would have derived from the same facts in some other year. The answer is that for these 3 years, from 1947 to 1949, almost the whole financial community was indulging in a mass delusion. With all the ease of hindsight, we can now sit back and see that what appeared so frightening then was almost as little related to reality as the terror that gripped most of Christopher Columbus's crew in 1492. Night after night, most of the common seamen on the Santa Maria were unable to sleep because of a paralyzing fear that at any moment their ship would fall off the ends of the earth and be lost forever. In 1948, the investment community gave little value to the earnings of any common stock because of the widespread conviction that nothing could prevent the near future bringing the same type of bitter depression and major stock market crash that happened about the same number of years after each of the 2 preceding major wars. In 1949, a slight depression did occur. When its modest nature was appraised and the financial community found that the subsequent trend was up, not down, a tremendous psychological change occurred in the way common stocks were regarded. Many common stocks more than doubled in price in the following few years due to nothing more than this psychological change. Those common stocks which also had the benefit of more tangible outside occurrences improving their fundamental worth did a great deal better than just doubling. These great shifts in the way the financial community appraises the same set of facts at different times are by no means confined to stocks as a whole. Particular industries and individual companies within those industries constantly change in financial favor due as often to altered ways of looking at the same facts as to actual background occurrences themselves. For example, in certain periods the armament industry has been considered unattractive by the investment community. One of its most outstanding characteristics has been considered to be domination by a single customer, the government. This customer in some years goes in for heavy military procurement and in others cuts buying way down. Therefore, the industry never knows from one year to the next when it may be subject to major contract cancellations and drying up of business. To this must be added the abnormally low profit margin that customarily prevails in government work and the tendency of the renegotiation laws to take most of what profit is made, but never correspondingly to allow for a mistake in calculations that causes a loss. Furthermore, the constant necessity to keep bidding on new models in a field where engineering changes come continuously means that risk and turmoil are the order of the day. It is impossible, no matter how good your engineering, to standardize anything that gives your company a long-term advantage over the aggressive competition. Finally, there is always the danger that peace might break out with an accompanying decline in business. When this view prevails, as it has many times in the past 20 years, the defense shares sell at a quite low price in relation to their earnings. However, the financial community has at times in the recent past derived other conclusions from the same set of facts. The world situation is such that the need of heavy expenditures for airborne defense equipment will be with us for years. While the total value may vary from year to year, the pace of engineering change is causing more and more expensive equipment to be needed so that the long-range trend will be upward. This means that the happy investor in these securities will be in one of the few industries which will in no sense feel the next business depression, which sooner or later will be felt by most other industries. While the profit margin is limited by law, so much business is available to the well-run company that this proves no ceiling upon total net profits. When this view prevails, a quite different appraisal is being given to exactly the same background facts. These stocks then sell on a quite different basis. Examples could be given for industry after industry which in the past 20 years has been looked upon first one way, then another, by the financial community with a resultant change in quoted values. In 1950, pharmaceutical stocks were generally regarded as having about the same set of desirable characteristics usually credited to industrial chemical companies. Endless growth due to the wonders of research and a steady rise in the standard of living seemed to warrant the best of these shares selling at the same ratio to earnings as the best of the chemicals. Then a single manufacturer got into trouble on a heretofore glamorous item. The realization swept the financial community that this was a field in which dominance today is no assurance of being even one of the top companies tomorrow. A reappraisal of the entire industry took place. Completely different price-earnings ratios prevailed, due, in all cases but one, not to a different set of facts but a different appraisal of the same facts. In 1958, just the reverse took place. In the business slump of that year, one of the few industries that enjoyed increased rather than decreased demand for its products was the drug manufacturing industry. Profits of most companies in this group rose to new highs. At the same time, earnings of the chemical producers fell rather sharply, largely because of excess capacity from major expansion moves that had just been completed. The volatile financial community again started sharply upgrading the price-earnings ratio of drug shares. Meanwhile, sentiments started to grow that the chemical stocks were not as attractive as had previously been supposed. All this represented only changed financial appraisals. Nothing of fundamental or intrinsic consideration had happened. A year later, some of this new sentiment had already been reversed. As the better chemical companies proved among the first to recover lost earning power and as their growth trend caused profits soon to go to new all-time high levels, they rather quickly regained their temporarily lost prestige. With the long-range significance of an ever-growing number of important new drugs tending further to bolster the status of the pharmaceutical stocks as against governmental attacks on pricing and patent policies of this industry working in the opposite direction. It will be interesting to observe over the next several years whether the recently regained standing of the pharmaceutical stocks grows still further or starts to shrink. In the original edition, I went on to give one, then current example of this same sort of changed financial appraisal by saying, one more example is a change in outlook that is taking place right now. For years, the shares of the machine tool manufacturers have sold at a very low ratio to earnings. It was almost unanimously felt that machine tools were the epitome of a feast or famine industry. No matter how good such earnings were, they did not mean much because they were just the product of a prevailing boom and could not last. Recently, however, a new school, while by no means predominating the thinking on this subject, has been gaining converts. This school believes that since World War II a fundamental change has taken place affecting these companies. All industry has been swinging from short to long-range planning of capital expenditures. As a result, the cause of extreme fluctuation for the machine tool companies has disappeared. High and rising wage rates will prevent for many years, if not forever, a return to the feast or famine nature of this business. The steady pace of engineering advance has increased and will further increase the pace of obsolescence of this industry's products. Therefore, in place of the largely cyclical pre-war trends, the growth trend of the recent past will continue further into the future. Automation may cause this growth trend to be spectacular. Under the influence of those who think this way, the better machine tool stocks are now appraised on a somewhat more favorable basis in relation to the market as a whole than they were only a few years ago. They still sell at a rather low ratio to earnings because the influence of the feast or famine idea is still strong, even if it is not as strong as it used to be. If the financial community comes more and more to accept this non-cyclical and growth outlook for machine tool stocks, their price-earnings ratio will improve more and more. They will then do much better than the market. If the old feast or famine concept regains its former hold, these shares will sell at a lower ratio to earnings than prevails today. This current machine tool example brings into clear relief what the common stock investor must do if he is to purchase shares to his greatest advantage. He must examine factually and analytically the prevailing financial sentiment about both the industry and the specific company of which he is considering buying shares. If he can find an industry or a company where the prevailing style or mode of financial thinking is considerably less favorable than the actual facts warrant, he may reap himself an extra harvest by not following the crowd. He should be extra careful when buying into companies and industries that are the current darlings of the financial community to be sure that these purchases are actually warranted, as at times they well may be, and that he is not paying a fancy price for something which, because of too favorable interpretation of basic facts, is the investment fad of the moment. Today, of course, we know the answer to the recent ideas of some that the machine tool industry is no longer feast or famine in its nature. The 1957 recession completely exploded the idea that long-range corporate planning now cushions these stocks from their normal extreme vulnerability to downward movements in the business cycle. However, for every problem of the sort which gets solved, the ever-increasing pace of today's technology opens up a dozen others from which the wise investor can profit if he can think independently of the crowd and reach the right answer when the majority of financial opinion is leaning the other way. Are the exotic fuel stocks and certain of the smaller electronics intrinsically worth the high appraisals being given them today? Is there such a future for manufacturers of ultrasonic equipment that ordinary price earnings may be disregarded? Is a company better or worse for the American investor if an abnormally large part of its earning power is derived from foreign operations? These are all matters about which the ideas of the multitude may have swung too far or not far enough right now. If he is thinking of participating in the affected companies, the wise investor must determine which are fundamental trends that will go further and which are fads of the moment. These investment fads and misinterpretations of facts may run for several months or several years. In the long run, however, realities not only terminate them, but frequently, for a time, cause the affected stocks to go too far in the opposite direction. The ability to see through some majority opinions to find what facts are really there is a trait that can bring rich rewards in the field of common stocks. It is not easy to develop, however, for the composite opinion of those with whom we associate is a powerful influence upon the minds of us all. There is one factor which all of us can recognize, however, and which can help powerfully in not just following the crowd. This is realization that the financial community is usually slow to recognize a fundamentally changed condition unless a big name or a colorful single event is publicly associated with that change. The ABC company's shares have been selling at a very low price, in spite of the attractiveness of its industry, because it has been badly managed. If a widely known man is put in as the new president, the shares will usually not only respond at once, but will probably over-respond. This is because the time it takes to bring about basic improvement will probably be overlooked in the first enthusiasm. However, if the change to a superb management comes from the brilliance of heretofore little-known executives, months or years may go by during which the company will still have poor financial repute and sell at a low ratio to earnings. Recognizing such situations prior to the price spurt that will inevitably accompany the financial community's correction of its appraisal is one of the first and simplest ways in which the fledgling investor can practice thinking for himself rather than following the crowd.